Welcome to The Explainer. Today we're jumping right into a huge question for income investors. Is Coca-Cola's legendary Dividend still a safe harbor for long-term growth? We all know the iconic brand, but a recognizable logo doesn't automatically mean the financial engine under the hood is running smoothly right now. So we're going to strip away the branding and look purely at the data.
62. That is just a massive, mind-boggling number. For 62 consecutive years, Coca-Cola has increased its dividend, officially crowning it a true dividend king. Just think about what the global economy has survived over the last 6 decades. We're talking recessions, wild inflation spikes, totally shifting consumer trends, global crises, and through absolutely all of it, Coca-Cola's management never once missed their annual dividend hike. That kind of ironclad track record is exactly why it's the bedrock of so many income portfolios.
To get the full picture today, we're going to cover their Dividend King legacy, yield and payout safety, the global revenue engine, competitors and threats, valuation forecasts, and finally, our overall verdict.
Let's start with Section 1, the Dividend King's Crown, a legacy of income.
It's really critical to acknowledge the historical context before we scrutinize the current metrics. Since the mid-20th century, Coca-Cola has weathered every economic storm without ever missing a beat on that annual dividend hike. If you're looking for predictability, this 62-year streak sends a loud and clear message. Management prioritizes shareholder returns almost above all else, signaling immense confidence and structural cash flow resilience.
Moving on to Section 2, yield and payout safety, peeling back the layers. Historical reliability is a great story, but dividends are paid with today's hard cash, right? Based on the latest ticker analysis, the current 2.7% yield is actually 6.9% lower than the stock's 5-year average. And that 5-year compound annual growth rate? It's a slow and steady 3.4%. So right out of the gate, we're seeing that you're buying a slightly lower initial yield than usual, and the growth rate is basically just pacing historical inflation rather than rocketing higher.
But here is the crucial metric you really need to watch: the 75.6% payout ratio. This means the company is taking over 3/4 of its $2.47 earnings per share and handing it straight back to shareholders. In the world of dividend safety, a payout ratio between 70 and 90% tells us there's moderate risk. They absolutely have the means to pay it, but if profits were to unexpectedly take a hit, that leaves a pretty small cushion for emergencies.
Fortunately, Wall Street expects that pressure gauge to release some steam. Analysts project the payout ratio will actually drop to a much safer 68.4% next fiscal year. If earnings can just grow a little faster than the dividend payout, the corporate piggy bank gets some much-needed breathing room, giving you more long-term security.
Section 3, the global revenue engine, funding the dividend.
To truly understand how Coca-Cola safely funds these massive payouts year after year, we have to look at the sheer scale of the operation. Out of $48.1 billion in net revenues, 60% comes from outside their flagship North American market, from Europe and the Middle East to Latin America and the Asia Pacific. This brilliant geographic spread is the ultimate safety net. If one regional economy stumbles, this globally diversified engine just keeps churning out the cash to protect your payout. And they aren't just doing business in these 200-plus countries. They are completely dominating. Securing over a 50% value share in sparkling drinks internationally ensures that cash flow remains historically stable, even when regional economies dip. That level of market penetration is exactly what gives them tremendous, repeatable pricing power.
Section 4. Competitors and future threats. Operating in a crowded market.
Because let's face it, Coca-Cola does not operate in a vacuum. Securing future growth means fending off intense competition. While Coke leads as a pure-play beverage giant, you've got rivals like PepsiCo leveraging a massive food and snack business for broader reach in the grocery aisle. Meanwhile, agile niche players like Celsius are aggressively capturing the highly profitable, wellness-oriented consumer with functional energy drinks. Defending the fortress requires constant innovation against both massive diversified giants and trendy newcomers.
To stay ahead of the pack, Coca-Cola is aggressively restructuring. They've just unified marketing, commercial, and digital operations under a new chief digital officer, Sadef Salilan-Jassin. The goal here is simple but crucial: leverage real-time data to make faster decisions and understand consumers on a deeper level. Protecting their market share and your dividend now relies heavily on acting more like an agile tech company than a traditional bottler.
Next up, Section 5, valuation and growth forecasts. Pricing the premium.
We absolutely have to talk about the price tag, because buying a safe dividend at the wrong valuation can completely sabotage your long-term returns. Simply Wall Street recently shared a really interesting perspective, suggesting the stock sits roughly 25% above its fair value as it evolves from a sugary icon to an everyday beverage leader. So at a stock price near $82, a lot of their future success and reliable compounding might already be baked right into the price.
Let's put that into perspective. At a 25.9 times price-to-earnings ratio, Coca-Cola is significantly richer than the global beverage average of 17.1. Now sure, it is slightly cheaper than some direct peers sitting around 27 times earnings, but you have to ask yourself, are you paying a steep premium for untouchable quality, or does this price just leave way less room for error if consumer sentiment suddenly cools down? And here's a highly important detail for you to factor in. Analysts expect dividend growth to actually slow down to an average of about 5% over the next 2 years. While that might sound like a bit of a letdown if you're chasing rapid yield, it's actually a super prudent, smart move by management. It prevents that 75.6% payout ratio from climbing any higher, allowing earnings to catch up and ultimately keeping the dividend incredibly safe over the coming decade.
Finally, Section 6, the final dividend verdict, weighing safety versus price.
So, bringing all these data points together, what's the takeaway? You have a company with an untouchable 62-year track record and a massive global engine shielding it from regional shocks. The ongoing operational restructuring shows they certainly aren't resting on their laurels. But it's a tug of war. You're buying in at a premium valuation compared to the broader industry. The starting yield is slightly below its historical average, and management is actively tapping the brakes on dividend growth to keep the payout ratio safe.
So I'll leave you with this to ponder for your own portfolio. When you're building an income strategy, is paying a premium price for the absolute, legendary safety of the Dividend King's crown still worth it in today's market? Or does a high valuation and moderating growth push you to hunt for yield elsewhere? Take a hard look at your risk tolerance. Thanks for joining me for this explainer, and keep objectively testing your assumptions.